How people bought homes before mortgages. Imagine finding your dream home today but discovering that banks, mortgages, and monthly home loans simply didn't exist. No mortgage applications. No 30-year payment plans. No credit checks. Would owning a home become impossible, or would people find another way? Surprisingly, for centuries Americans bought homes without anything resembling the modern mortgage system. Long before banks dominated the housing market, families depended on savings, personal trust, community relationships, and creative financial arrangements to secure a place to live. The story of homeownership before mortgages is not just about money. It is a story of patience, sacrifice, and an entirely different way of building a future. During the colonial era and throughout much of the 19th century, most Americans did not purchase homes the way people do today. Instead of borrowing large amounts of money from banks, many families built their own homes using materials gathered from nearby forests and local land. Neighbors often came together to help raise barns and construct houses in community events that strengthened relationships while reducing costs. Labor was frequently exchanged instead of paid with cash, making cooperation one of the most valuable currencies in early America. Even when families wanted to buy an existing home, they usually had to pay a very large portion of the purchase price immediately. Banks were small, local institutions and rarely offered long-term home financing. Most lenders preferred short-term business loans instead of tying up their money in houses for decades. As a result, homeownership required years of careful saving before a purchase could even be considered. For working-class families, this meant delaying the dream of owning a home until enough money had been accumulated. Seller financing became one of the most common alternatives. Instead of borrowing from a bank, buyers often made agreements directly with the property owner. The seller accepted a down payment and allowed the remaining balance to be paid over several years. These arrangements depended heavily on trust because both parties relied on handwritten contracts and personal honesty rather than large financial institutions. If either side broke the agreement, resolving disputes could be difficult. In many rural communities, reputation was as important as cash. A person known for honesty and hard work could often negotiate better payment terms than someone with greater wealth but a poor reputation. Landowners believed that character reduced financial risk, making trust one of the most valuable assets a buyer could possess. Family also played an important role in helping people become homeowners. Parents, grandparents, and relatives frequently provided land, loans, or financial assistance to younger generations. Some families divided farmland among children, while others helped build houses together over many months. Instead of depending on banks, many Americans depended on their relatives and close communities to create opportunities for homeownership. As the United States expanded westward during the 19th century, land became available through government programs and private sales. Many settlers purchased inexpensive land and built simple cabins before gradually improving their homes as their financial situation improved. Rather than buying a finished house, many families created one room at a time, adding extra space only after earning enough money. Homeownership was often a long process rather than a single purchase. The Industrial Revolution changed everything. As factories attracted millions of workers into growing cities, demand for housing increased dramatically. Urban land became more expensive, and fewer people had the ability to build homes themselves. Buying property now required larger amounts of money than many families could save. Banks slowly recognized an opportunity, but early home loans were very different from modern mortgages. Borrowers often received loans lasting only 3 to 5 years. At the end of that period, the entire remaining balance became due in one large payment. Many families expected to refinance the loan or sell the property before reaching that deadline. If economic conditions changed, refinancing could become impossible, causing many homeowners to lose their houses. The financial crisis of the Great Depression exposed serious weaknesses in this system. Banks failed, unemployment soared, and millions of Americans could no longer repay their loans. Thousands of homes were lost through foreclosure, creating one of the largest housing disasters in American history. This crisis forced the government and financial industry to rethink how home financing should work. During the 1930s, major reforms gradually introduced longer repayment periods, lower monthly payments, and safer lending practices. These changes eventually evolved into the modern mortgage system that most people recognize today. Instead of paying off an entire loan within a few years, buyers could spread payments over decades, making homeownership possible for millions of middle-class families. The modern mortgage transformed American society. More families could purchase homes, suburbs expanded rapidly after World War II, and home ownership became a symbol of financial stability and the American dream. Yet this convenience also changed the relationship people had with debt. Previous generations often waited years before buying a home because they refused to borrow large sums of money. Modern buyers gained faster access to home ownership but accepted decades of monthly payments in return. Looking back at life before mortgages reminds us that owning a home once depended less on financial products and more on patience, community support, family cooperation, and personal trust. The methods were slower, more difficult, and often uncertain, but they reflected a world where relationships carried as much value as money itself. The next time you hear the word mortgage, remember that for generations of Americans, the path to homeownership was built not by banks, but by determination, reputation, and the willingness of families and neighbors to help one another create a place to call home.